Vice Chairman, thank you so much for joining us. What is the aspiration to reflate? How do we get to an inflation that is desirable?
Well, thank you, Tom, and happy to do your show. Look, we have the same goals we've always had. We want maximum employment, and we want price stability, which we define as 2% inflation in the long run. But we recognize that the world today looks a lot different than a decade ago, and we're spending a lot of time in the U.S. and abroad at the lower bound on policy rates. That puts downward bias on inflation and upward bias on unemployment. So to offset that bias, that new normal that we're operating in, what we said in our framework review is that appropriate monetary policy, when you come out of recessions and into recoveries, will not view 2% as a ceiling. We want to actually spend some time above and below 2% so we can anchor inflation expectations. We gave some very, very significant forward guidance in our meeting recently. What we said is that we expect we're going to keep rates at the current level, which is basically at zero, until we've reached maximum employment and until inflation has reached 2%. So lower for longer, and we've given some observable metrics that will indicate when that liftoff can happen.
The modesty of the Vice Chairman here, folks, is simple. In 2014, Richard Clarida drove forward the phrase, the new neutral, which was shockingly prescient at the time. I want to go to the robust evolution now you and the theorists are going to and what it means across our radio and TV audience. And it's real simple here. We want to know on the glide path where you step in. Do you wait ex post until you finally see a substantial inflation? Do you begin to act along the way? Or is there somewhere in between, as Megan Green says up at Kennedy, is there a place where you see the whites of inflation's eyes and you act?
Well, as we've said, and let me state it again. In our meeting, we indicated that we expect that rates will be at the current level, which is basically zero, until actual observed PCE inflation has reached 2%. That's at least. We could actually keep rates at this level even beyond that, but we're not going to even begin to think about lifting off, we expect, until we actually get observed inflation, and we measure it on a year-over-year basis, equal to 2%. Also, we want our labor market indicators to be consistent with maximum employment in the labor market. And so we've been very clear about that. If you will, that's the whites of their eyes. We want to see actual inflation at 2%.
So, Richard, this is really important. Is it fair to say that an overshoot of 2% is not a prerequisite for liftoff then? It's just 2%?
Well, what we've said is that inflation, in our judgment and looking at a range of indicators, needs to be on track to moderately exceed 2% for some time. That'll be a judgment that we make as we get closer to that number. But our guidance is very clear. We want to see actual inflation. We measure it on a year-over-year basis at 2%. And we don't want it to be a fleeting, 1 quarter and done. And at that point, we'll assess what is the appropriate liftoff and the timing, but that's really down the road. It's really the liftoff is not till we get actual inflation and maximum employment in line with our objectives.
On Wall Street, there's always some confusion because there are various Fed presidents going around saying their own thing. And I think where there is some confusion right now is whether the Fed is simply prepared to tolerate an overshoot or at least anticipate one in the future or actively calibrating policy to drive one. So be clear if you can.
I'll be very clear. I'll be as clear as I can. We said in our new framework statement that was unanimously approved in August that appropriate monetary policy following periods when inflation's been persistently below 2%, appropriate monetary policy will aim for the inflation rate to moderately exceed 2%. For some time. And that's an important difference with our prior framework in which we thought a 2% ceiling was great. We now think that to anchor inflation expectations at 2%, we need, coming out of recessions, to spend some time above 2% to balance off those times when we've been below.
So how do you reconcile that with the forecasts?
It's very simple. And I'm glad I'm doing this show to make a very obvious but important point. The economy has taken the most severe hit since the Great Depression. We had a 30% collapse in economic activity. We had a 22 million increase in unemployment. Absolutely staggering numbers. The economy now is beginning to recover. Our projections, Jonathan, that we released with our September SEP indicate that our baseline view, and as Chair Powell indicated, there are risks, but our baseline view is that within about 3 years, we're going to get back to a very low unemployment rate and inflation at our 2% objective. In the prior economic downturn, that took 9 years. So we actually see, relative to historical experience, a pretty impressive return in our baseline projection. But that said, we have to support the economy to get to full employment, to get up to our 2% objective. And at that point, of course, we can then start talking about what happens beyond that. But let's don't forget the deep hole that the pandemic has put us and the world economy in. Absolutely. So that's the factor.
I think you'd appreciate, though, for some people, though, because it's not in the forecast, they believe that perhaps policy is not calibrated appropriately to generate that overshoot, that if this Fed wants the overshoot over a forecastable horizon, then they're not doing enough.
Well, what we're saying quite simply is that perhaps in a normal recession, or perhaps if we were back in February, then obviously getting to 2% and moderately exceeding 2% would be within our forecast horizon. But because of the depth of the shock, the economy has to recover. And as I said, in our baseline, that recovery relative to the last downturn will occur within about three plus years. But until we get to that point, overshooting is just an academic point. And we actually want to get the economy to 2% inflation and maximum employment. And we think, along with fiscal support, that can happen.
Meanwhile, fund manager after fund manager has come on this show and said that we are at risk of creating an asset price bubble, if not having created it already. How does that factor into your calculus about when to tighten policy?
Well, that's a good question. And obviously, financial stability is always, and certainly in the Powell Fed, an important consideration. We get regular briefings on financial stability. We issue a twice yearly report. So we're very attentive and attuned to that risk. But it's also important to remember, Lisa, we have a dual mandate assigned from Congress, which is maximum employment and price stability. If hypothetically we were to become concerned that financial stability put our maximum employment and price stability goals at risk, then we would have to factor that in. But Lisa, we also believe that monetary policy, raising or lowering rates, is a pretty blunt instrument, and our inclination and our preference at the Fed is to work with other agencies on regulation, supervision, bank liquidity, and other dimensions than simply raising or lowering rates to deal with financial stability.
I guess another way of asking this is, how effective can the Fed be without more fiscal support, without another round in Washington, D.C. that's substantial, that injects direct aid to companies, to individuals?
Well, as Chair Powell indicated, and we all believe, obviously fiscal policy is for the Congress and the executive branch. But when asked, what we'll say is we do think that additional fiscal support will likely be needed. I think it's very clear that the CARES Act, which passed in March, was really a historic government response to a historic crisis. A $3 trillion package provided significant support to the economy. The economy's made a lot of progress, Lisa. About 11 million jobs have returned, but there's still a deep hole. We still have a very high rate of unemployment. We have a lot of small and medium-sized businesses that are suffering. And so, yes, additional fiscal support will likely be needed.
Vice Chairman, I want to go back to your work with Gertler and Galley of years ago.
Yeah.
Folks, this is acclaimed work from the 1990s, which talked about the dynamics of our system away from the static models of the previous century. Vice Chairman Clarida, we have been shocked by 1, 2, 3 once-in-a-lifetime events. And the one that I don't see in the literature, which has been a theme of John Farrow, myself, and Lisa Abramowitz, is the new digital dominance. Our nation is being crushed by the shocks of technology. In DSGE models and what you're grinding through day to day at the Fed, how do you adapt to the shock of this new digital dominance?
Tom, it's a great point, and the quick bottom line is that improvements in technology and productivity are disinflationary. That is, if you don't offset them, they tend to push inflation down. Interesting, in Clarida, Galley, we pointed that out, that you need to run a very accommodative policy, otherwise you get deflation with technology. And so that is a factor that has been imparting downward bias to inflation. I think technology, along with globalization, along with the new neutral, as you called it, all are working together to create disinflationary pressures across the globe that at the Fed that we're trying to offset with our policy framework.
It's important, Vice Chairman, to know that people are listening. A gentleman named Michael McKee, emails in and says, look,
Hi,
there
Mike.
seems to be a fiscal divide here between Bullard of St. Louis and Powell. And I know that everybody's got their own opinion, as Lisa and John mentioned. But the fiscal urgency right now, how do you fold the shock of an increasing deficit, the delta, the marginal, the first derivative of fiscal shock? How do you fold that into your Fed model? How urgent is it to get that fiscal space, that advantageous space?
Well, again, that's a decision for the executive and the legislative branch. What I will say about that is the economy is recovering robustly, but we're still in a deep hole. So it's important, and I'm sure Mike knows this, that we are recovering, we're growing, and growth will probably be very rapid in the third quarter, but the hole is very deep. And at a point where you've got a deep hole, high unemployment, and you have, like the U.S. does, fiscal space, it is appropriate to use that. You know, longer term, obviously, the U.S. needs to get back on a sustainable fiscal path, but you don't want to start that in the midst of the worst economic hit in 90 years.